So today, my name is Doc Severson. I'm going to be going over 4 powerful rules for forecasting any chart in any time frame. The first thing I want to talk about, and I'm also an ex-engineer, so the first thing that we typically do is define what is the problem statement. What are the requirements? What is it that we're trying to do? What is it that we're trying to fix? And so I have some very definite opinions of what I think is broken today, which is, I think in short supply is accurate charting and price discovery, leading to the proper trade analysis for you to get edge in today's market. Now, through this path, I've also had to understand what's happening with human nature. Why do I make those chimpanzee type decisions that we all seem to do? That dinosaur brain that makes you almost do the exact opposite thing towards getting profits. So I've had to learn about neuro-linguistic programming as well as the subconscious mind. So that's going to sort of color some of the discussion today. So let's talk about how we all start in this business. So unless you're lucky enough to snag a job in the street out of college, everybody starts in the same manner. We are all herd animals. This is why we love going to football games where there's 100,000 people there cheering for the home team. It feels great, right? It is so much fun being part of something bigger than yourself. And this is always something that you hear about from people saying, you know, I just want to be involved in something bigger than me. So we do that. We all sort of gravitate towards, you know, running in packs. And this is why it's so difficult for people today, because we're being isolated. But at the same time, we're used to this social logic. We trust social opinion, don't we? And we've come to depend on this sort of technology in our own lives. Say, for instance, if you wanted to buy a katana sword with some throwing knives in there, you can just go out to Amazon and you can find this excellent specimen here for only $24.95, which is rated 4 stars with 412 ratings. So therefore, it must be okay. There's even 146 answered questions on this sword combo. So pretty quickly, you get an idea of how society feels about this combination katana and throwing knife kit. Or you can also consider eating dinner tonight at the Bacon Bros Public House, which is 4 stars, 696 ratings on it. So you get the feeling that a lot of people have eaten there before. So this has been going on for the better part of a generation now. For about the last, I would say, almost 20 years now, we've been in this sort of, you know, socializing culture in terms of what we should be doing. We're letting other people make opinions for us and make decisions. So that goes into what I call social investing. Why can't we do the same thing in markets? And this is the first thing that people do is they download their Robinhood account, they stick their $50 into it, and then the first thing that they do is log into some form of stock trading social media, whether it's a Discord site or Twitter or whatever have, right? So this becomes the next video game, right? It's just another extension of what we do. It's a competitive video game. This just happens to be the stock market. So retail traders get into these financial markets thinking that the safest thing to do is to go along with what everybody else is doing. And that is a huge mistake, because we soon find out that there's sharks in those waters and we're just going to get chewed up. And you see it all the time in some of these sites, like, you know, some of the major Discord sites that are out there are just, it's just unbelievable, some of the discussion that happens inside of there. But it's not surprising. This is never going to work for you. So a lot of people get through with this. They finally get to the point of saying, hey, you know, maybe this isn't working out so well for me. Maybe I should go with the pros. And so they go into the investing media. And this is no safer. You know, some really interesting things that have happened recently, like a lot of people are aware of this. Bill Ackman came on. He's the CEO of Pershing Capital. He came on about a month ago onto CNBC and scared the crap out of the collective market, didn't he? Now, he was short while he walked into that studio. And about 3 or 4 days later, he covered and went long. Was what he did illegal? No, it's not illegal. There's nothing that Bill Ackman did that was wrong. He shared his opinion. He did talk his book, though. So there is nothing illegal about it, but unless you know any better, you're going to be taken advantage of, because a lot of people went short right at that point and are just now covering to the upside. Oops. So you think the investing media is your key to knowing what's about to happen in the markets? No, it's about clicks. It's about getting views. It's about putting that cool looking thumbnail on the post that makes you click on it, that gets them ad revenue. It's nothing about servicing you or making you a better investor at all. It's all about them trying to find some way to get, beyond the paywall, to get revenue in their own site. So you are just the product, unfortunately. And with any luck, you'll figure this out within a year or two to say, you know what? It's actually doing me more harm than good to watch the financial media. So we end up looking for some type of guidance. By this time, maybe this is a year or two into your venture. You're like, man, what the hell do I do here? Like, I can't go to social media. I can't talk to my friends. I can't talk to the crowd. None of that stuff works. I can't even go to the financial media to figure out what's going on. There's got to be somebody out there that can help me understand what to do. And so this is where you get into the hunt for the mentor, the guru, maybe the person that can help you get over the threshold, quit pushing the stone up the hill. So this is how we start, and then this is how we get to the next point. We quickly realize that, you know what, nobody cares about my own situation as much as me. And maybe a lot of you have gotten to this point now. You realize that, look, nobody is out there really looking out for you, with few exceptions. So you have to figure out your own plan. And this is actually, in my mind, this is the holy grail of trading, is once you accept responsibility for your own results, then you're on the path, because then and only then will your subconscious mind allow you to make those risky decisions without getting in the way. Only if you've done the work, though. So as we get to this point, you understand what you are trading. You've stopped trying to be the jack of all trades. And if you're trying to be the jack of all trades, you will be the master of none. You finally, by this point, maybe figured out what you trade and why you trade. You're not trying to trade everything that's out there. You don't have 20 monitors sitting up in your bedroom monitoring everything that's moving. Okay, you've started to get some focus into your trading. You now have a plan. Failure is not an option, as Gene Kranz once famously said. You have a plan and you're treating this like a business. Okay, and now we get into price discovery. So yes, maybe some of you are just purely statistical traders. You've got a framed copy of the Random Walk Down Wall Street book, and you don't believe in charts. You believe that charts are where they belong, which is at the bottom of all the other sunken ships that are out there. Okay. And maybe this is the case for some of you that traded on the floor. This used to be where price discovery happened. You could literally smell the price discovery when you were on the trading floor. And they were the reason why markets moved, and you could actually see it in front of you why things were moving. And this is why so many of those traders, the floor traders, moved off the floor, upstairs is the expression, and started losing money because they lost their edge. So more and more these days, today's challenge is to understand how to do price discovery from a chart on a monitor. So solitary price analysis, just you and the chart. And so many of us here today are doing specifically this. Okay, and so there's a different way that we do that as well too. So once you start that down that path, the analysis game starts out, right? Don't we all have a favorite indicator, or doesn't our favorite mentor or guru have a favorite indicator that they're trying to push you on? And that's the case. And so nobody has ever told you where to stop with something like this. We can't really get a grip on what's happening. We get into this just one more study mode. Well, maybe we start with just price on our chart. We got this beautiful chart here with, this is TrendSpider, I believe, of the S&P 500 as of this morning. and it looks gorgeous, right? Well, but it's too clean. We can't understand what's going on unless we add some moving averages. Okay, now we know what's going on. There's a death cross on the S&P 500 between the 200 and the 50, but it's still not enough because we need to add Wells Wilder and his MACD indication. Okay, no chart is a real chart unless it's got MACD on it, right? Okay, we're losing some momentum on that move up, but something else is missing. Maybe we need an oscillator. So let's add that stochastic onto there. Gerald Apple and his stochastic, and there we go. Okay, but just not quite there yet. No chart is can be considered a real chart without RSI, right? Relative strength, another Wells Wilder thing that we've got down at the bottom there. So, okay, but we need to add some type of volatility envelope. So we need to add John Bollinger and his work onto here, the Bollinger Bands. Now we have a sense of statistical deviation from an average. Okay, but that's not enough because we need to know how that reflects with the ATRs, and we've added the Keltner channels and the Bollinger Bands together to understand what's happening with that. But that's not enough because somebody talked to me the other day about the Arun indicator and said that it was the 100% positive made him into a millionaire. So I've got to add the Arun on there. And then, somebody else was talking about another one of Wilder's inventions called the ADX. And this is what happens to us, guys. Next thing you know, we've gotten all this crap stacked onto our charts, and the only thing that we've left with price is this little skinny thing that's up here. We can barely see what's going on with the price at all because we've got all these derivative indicators down here, and we just made an utter mess out of our chart. I used to see this all the time. Like, nobody ever knew when to stop adding studies to the chart because it was in this mode of just one more thing. And that to me is a great sign of someone that's trading not to lose instead of trading to win. That is scared capital in a word if you've got too many studies on your chart. More is not better. So is there a simpler way to do that? You've twisted yourself into a pretzel with indecision. You'll end up trading not to lose instead of trading to win. Maybe we should simplify things. How about if we do that? What about if we started with price? Uh-oh. We'll get to that in a minute. So price is never lagging. That's an important thing, that understand that every study that's out there is a derivative of price and volume. And it's also not based on some derivative study written 50 years ago by some dude you'd never heard of before. Indicators lie all the time because of this lag. Price never lies. Price is always the ultimate arbiter of value. It is never wrong. If you're yelling at your chart, then you are the one that's wrong. Price reflects everything that is currently known about the asset this very second. Markets are very efficient in terms of this. But Doc, it's hard. I used to have the same objections, right? You can either keep doing the same thing and hope for different results, or you can learn what the rest of the professionals did long ago. More excuses will just waste your time. So let's get started with rule number 1 of the 4 rules. 4 powerful rules. Rule number 1, larger time frames dominate the trend. The rules are simple, perhaps so much so that your mind will fight you and say, nah, that's too simple. It can't be that easy. So first of all, rule number 1 is that larger time frames dominate the trend. This is where I see a lot of confusion on time frames. I see a lot of traders arbitrarily slapping up charts. Well, I trade the 5-minute chart. Well, what about the 10-minute chart, the 15-minute, or the 1-minute chart? I use the 1-minute chart. Things like that. They're all over the map, and they end up living and dying with each candle on a chart that's mostly just intraday noise. There's no context to what you're doing. Context is massively important. Context means the surrounding conditions that drive that. So somebody following this very small time frame chart is just going to get whipped back and forth if they don't understand the tide that the smaller waves are following. The tide is a much bigger, more powerful thing, as anybody that's ever been on a beach understands. If you're at low tide, doesn't matter how big that wave is, it's way, way, way out there. The larger time frame charts are much more powerful than the intraday candles. This to me this is one of my favorite examples of this, and I love using analogies because analogies are things that people already accept and understand. And my job here today is to show you how much you already know about this. So let's say that we're going from point A to point B, we're walking a dog. Now, how are you going to go from point A to point B? At least when I'm walking my dog, I'm an engineer, so I'm fairly linear about things, right? I'm not stopping to paint the picture and then in between from point A to point B. I'm on a mission. By God, I'm going to get to point B if it kills me. Now, the dog is totally unaware of my mission. He has no idea that all I want to do is to get from point A to point B. Now, I do enjoy walking the dog, but he doesn't really care about that. He is there to sniff everything and to dominate everything around him. He's there to mark his territory. So what's he going to do? He's going to do an orbit around me. He's going to be all over the place. He's going to sniff out here. He's going to check over here, basically to the extent of the radius of that leash. That's where he's going to go. He's going to go everywhere within there. And no, my dog has never been through training before. It's a waste of time. So all he wants to do is just follow his nose, and he's just going to do this all the way to point B. So who sets the beginning and the ending points of your walk? You do. You're 10 times the mass. So does the dog show up at the same point? Yes, he does. But notice how much more real estate that he takes up. Notice how much longer he's going. Think of this as a larger time frame swing and a smaller time frame chart, tracing out all those little movements. It's the same thing. So now we get into what we call the weekly anchor, or just the anchor chart. Anchor chart is going to be, think of that as the person walking from point A to point B. So what I'm showing you here is just the swing, that swing on the weekly chart, which looks like just one big price movement, is actually made up of all these little smaller movements on the 60-minute chart. All over the place. It's walking all over the place, everywhere. Just like the little dog walking in orbit around me. Anchor, signal. So the context is important because the context shows that this swing is moving to the upside, as is the hourly chart, but it's making a lot more movements in there. So how do we use those? How? We'll get to that in a minute. So to apply rule number one, understand what larger time frames to add to your signal chart to create an anchor chart. So a lot of times people will say, well, look, if I trade off the daily chart, what should my anchor chart? Well, sometimes it can help to be the monthly chart, but quite honestly, a weekly chart is probably about what you want to do. However, if you're trading off an hourly chart, maybe even a daily chart will do for you. So I've showed an example here where we're using an hourly and a weekly, the weekly being the anchor, the hourly being the signal chart. Again, the signal chart is what you take the entries off of. So understand how to read the trend and the swing direction of your anchor chart. So what I'm just going to go back here. The trend is actually still to the downside on the weekly chart because we've gone to a lower low to a lower high. The trend is to the downside. However, the swing is to the upside. So we have two different things going on at the same time here. Understanding the difference between trend and swing direction. And so to me, this is my most important rule. And this goes whether or not we're trading intraday, we're day trading on the NASDAQ, meaning micro, or whether we're trading swing trades or anything like that. Trade in the direction of the anchor chart swing. If you're a dog, you want to go in the direction of your owner and not in the opposite direction of that. It'll make life so much easier for you. So enter that anchor swing on the signal chart, larger time frames dominate the overall trend. That is rule number one. It's simple. Don't fight against the larger time frames. You learned that early on when you were a kid, right? Don't pick on the bigger kids. That leads us to rule number two. Reversals. Reversals start from the inside out and they propagate higher. Reversals are the holy grail of trading. Wouldn't you agree? Reversals are what everybody's after. Everybody wants a reversal because they give the very highest reward to risk for a trade. Now, the anchor chart, for what made this so good as an anchor chart, because remember, rule number one, larger time frames dominate the trend. So it dominates the trend, but man, is it useless for spotting reversals. You can't spot reversals on the weekly chart. It takes weeks to do that. That's no good. I want something quicker than that. Understand, however, that change happens from the inside out. Things change from smaller to larger or from the inside out. And this is particularly important these days. One virus can infect a single host cell and begins to multiply and swamps your immune system. That's how they propagate. It starts with one, change begins from the inside out. If you drive the same car every day, you don't notice things wearing and degrading until somebody else drives it. Change is small. It happens a little bit at a time, but it eventually will end up, even that little rust speck on your car will eventually multiply and propagate. Change happening at small levels are early warning to possible failure or reversal. Now, that's why we need to use signal chart reversals. So if I go back to that 60-minute chart, here is the reversal that we saw. So we had a chart that was making higher highs and higher lows into sometime in February, and then starts to change polarity with a real hurry, didn't it? That's a reversal. And that change happened way before you can ever think of even seeing it on the weekly chart. And then we had the same thing happening on the bottom here recently. In late March, we had lower highs, lower lows. You guys remember your Dow theory, right? And all of a sudden, this is where it's important. We take out that prior swing high and the price starts to transition into an uptrend. Higher lows and higher highs. Yes, using the signal chart for those. Now, these reversals will propagate higher in time. We go from the 60-minute chart, the signal chart, and it eventually will propagate to the daily chart. So that was the original reversal right there. And then finally, the daily chart follows behind it with its own set of lower high and lower low reversal, just like the reversal off the bottom started with a higher low and a higher high. It happens later on. You spot it first at the signal chart. But the weekly reversal, again, this is useless. It hasn't even technically reversed to the downside yet. It's just a big swing down with a lower high on the weekly chart. So, applying rule number two, understand what smaller time frames to add to your signal chart to help spot changes in trend faster. Understand how to read the trend and the direction of the smaller time frame chart. You have to understand how to read price action. It's easy. Trade in the direction of the anchor chart swing until you see the signal chart reversing. That's your early warning. Remember, rule number two, reversals come from the inside out and they propagate higher. Okay, we're halfway through. Rule number three. This one is really super simple. You guys are going to make fun of me because this is so simple. It's a very simple rule, but I see it in play every day at every time frame, intraday or larger. Remember, everything that I'm talking to you guys about today is based on some kind of Newtonian physics. It's based on some principle that you see in nature every single day. What goes up must come down and vice versa. What rises must eventually fall. Unless it's going to get delisted, right? Unless the stock is going to get delisted, even something that's falling will eventually rise. We're not talking about a permanent rise or fall because price moves in waves. We will always see this. We will always see price moving like this in waves. You don't see something just completely drop to zero unless it's maybe luck and coffee. Okay, this is simple physics. So we can just take a signal chart and apply these trend lines to it, falling, and then a descending pattern will break to the upside. And then we see the same thing happening in reverse. We see an ascending pattern breaking to the downside as it breaks that trend line. Descending pattern breaking to the upside. And then eventually this ascending pattern will break to the downside. It just happens again and again and again. Okay, this is not predictive though. This works in every time frame, but obviously you'll see more instances of it on a smaller time frame like intraday. This is just framing things in for you guys. It's open to interpretation. A lot of people don't like these because they're subjective, but quite honestly, I think you can just see these things everywhere. Eventually, there's going to be a no doubt or break where something that's trending to the downside is going to break through that and start to work itself into an uptrend. Use this as a filter. And this is important here because, again, I understand the limits of this. Use this as a filter. It adds confluence to reversal signals. So in other words, when we see something like this, when we see a downtrend that's got a very clear trend line to it, and I didn't draw that very well, but you get my point, that very often at the same time that it changes polarity in terms of lower highs, lower lows, move to higher lows, higher highs, is going to be about the same time that it breaks that trend line. So just use it as a filter, kind of an early warning radar for your signal chart. That's rule number 3. Descending patterns break to the upside and vice versa. And now we get to rule number 4. Range expansion leads to range contraction and vice versa. This ain't your father's market anymore. Overbought and oversold. Somewhere along the way, traders got fed this notion of an asset being overbought or oversold. Who's to say, right? So we think we buy along with that because it's like, okay, there's days where I'm stuffed and there's other times during the day where I'm hungry. And so we sort of apply this towards overbought and oversold. And we apply all these value judgments towards stocks, don't we? But that's not right in a world where there's no limit on the money printing. So to me, this is just not right. And so we get into these modes where we can be overbought for a long period of time. Overbought for a long period of time. And I see people just getting all angry at the market. How can you get angry at the market? And then all of a sudden they're pointing and finger pointing and saying it's the Fed's problem and it's this problem. Guys, you can't trade the market that you want. You can only trade the market that is in front of you. You have to work with the tools that you're given. You can't go out there and change the market. You can be right. Moralistically, you can be right, but you're going to be dead wrong and dead out of capital if you continue fighting against what the market's giving you. Markets move differently today. They run as far as they can until exhaustion, and then they consolidate and then repeat. So this looks somewhat like this. They run as far as they can. They don't pull back because nobody's allowed to get on board, and then they will consolidate. They will consolidate and literally chop apart people that waited too long to get in. That's their punishment. That's their penance for getting in too late. And then it will run again like this, precisely at the moment when everybody gives up on that trend. Markets do this forever and ever and ever. They just keep going back and forth through this cycle. Markets copy nature, guys. Think about this. If you're going to climb Mount Everest, how do we climb Mount Everest? We start at a base camp down here. We acclimate ourselves to 5,400 meters, which is no joke. And then we make our first climb. Now, if we survive that, we're getting up to 6,100 meters. The body needs to acclimate itself. We'll spend maybe a week up there, a few days at the very least, acclimate ourselves at that level. We're going to recover from this big, ugly climb. And then we're going to go after the next one. We're going to go up to base camp 2. Range expansion goes to range contraction, goes to range expansion, goes to range contraction. Each base camp, we're going to hang out there for a little while. You don't just run up a mountain and summit that all in one day. This is how everything in nature moves. You go as far as you can, you rest. Go as far as you can, you rest. This is almost like our daily cycle. We go as far as we can, we go for 18 hours, and then we crash. Sleep for 6 hours, and then we do it again the next day. The same thing. So expansion and contraction on charts, we can see this too. We go between range expansion to contraction, where we build up a lot of energy. This is the choppiness index, by the way, guys. And then we trend, in this case to the downside, into exhaustion, where it builds up a lot of energy down here. Nonlinear price movement. Range expansion goes to range contraction, goes to range expansion, goes to range contraction. Expansion, contraction. Back and forth, over and over and over again. There is no overbought and oversold. We can also see this on something like a NASDAQ E-mini chart, looking at this tick charts. So it doesn't matter whether it's time or tick, we see the same principle in motion. Range expansion goes to range contraction. We build up a bunch of energy, and then we exit this price box in whichever way. We don't have to necessarily predict which way it's going to go. So this is why I call it boxing in the price consolidation. It helps me get in line and prepare for the next break from that, whether it's to the upside or the downside. Markets can do whatever they want to do. So applying rule number 4, using these principles will give us an early warning when a consolidating price chart is about to break out, as well as the converse warning when a trending price chart is about to stall out and rest. And I use these with options as well too, because if I see something going like that into exhaustion, I'm preparing for like some type of non-directional trade like an iron condor. And then once I see something building up like this, if we get a breakout trade, I'll take a vertical spread in that direction. Back and forth, back and forth. So I use the chop index linearity of the current trend to determine exhaustion and charged up levels. Range expansion leads to range contraction and vice versa. That is rule number 4. Now, how do we put this all together? Don't eat an elephant all at once, guys. Just identify things that you think that you can change with your trading today. So we talked about what is broken, about how socializing trading decisions is a bad thing. We talked about how people eventually gravitate towards charts as price discovery is easier to read visually and you don't have the floor anymore. But we also saw how many are still using outdated concepts of overbought and oversold that came before QE. So we said, hey, here's rule number 1. Larger time frames dominate the price trend. Choose an anchor chart. Understand anchor trend and swing direction. Trade in the direction of the anchor chart swing. That is rule number 1. Rule number 2 was that reversals start from the inside out and propagate higher in time frame. Reversals in trend will start at the signal chart or lower and will start to propagate higher in time frame. Change to market character begins from the inside. Then we had the simple rule number 3, ascending patterns break to the downside. Descending patterns break to the upside. It's just a filter. It is not a trade entry. And then we just talked about rule number 4, range expansion leads to contraction. Contraction leads to expansion. The cycle never ends. So let's summarize, and we'll put you right back on time here today. We've got about 2 minutes left. Remember, these 4 rules: larger time frames dominate the trend, reversals start from the inside out and propagate higher, descending patterns break to the upside and vice versa, range contraction leads to range expansion. How do you begin to start doing this sort of stuff? Well, I do have the book. The book is out there if you're curious on how this can add accuracy towards your trading. You can buy the Fractal Energy Trading Book in either Kindle format or paperback. I do recommend the paperback if you can. And that's available on Amazon today. Don't try to put all of these rules in play at once. Don't do everything at once. So start by defining your anchor and signal charts. Start to understand how the signal chart moves inside of the anchor chart. And you can have this sort of dog walk analogy. Look for trend lines and then start to apply the concepts of energy to your chart. Now, if you need more help, if you're curious about what we're doing here, consider joining me at readyset.trade. If you want to see how all these elements are brought together to make $100 a day, you can join us for an introductory rate. Use code FRACTAL at checkout. So look for the discount code FRACTAL in there. Or if you just want to join us for free and see what we're all about, go to this site here, readyset.trade/fractal for free access to our Discord community. So come join us on our community. Take care, everybody. Looking forward to hearing from you.